Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions.
All right, Tyler, today I hope you have a lot of tax questions because we're
Always.
talking, always, of course. We're talking year-end tax planning. Kind of give you a few things to think about, things to consider. And what I want to do today is on a couple of the things, hit on them and go a little deep, because a lot of times people give blanket kind of answers to this. Like, in the last few years, I've been seeing these commercials. Like, we have a dealership here in Lafayette, which is Hub City Ford. Mm-hmm. And they're always talking about buy an SUV, get a tax write-off. And it's just like, yeah, maybe. So what I mean by that is I want to get into some of the nuances of that, why you would maybe or wouldn't do that,
right?
Why it makes sense, why people say to do that. So let's kind of get right into it. That's the first thing on my list is consider asset purchases. So we're in the fourth quarter now. Today's October 8th. We're kind of, starting to look at.
And if you're listening, by the way, we got about 8 of these. So,
Okay,
hang on, folks.
Yeah, hang on. We're going to go through them quickly. This one I'll probably spend a little bit of time on because it's the one I get the questions about the most. So, people always, I'm sure you've heard this. I mean, and I've heard people say this to me. My CPA told me to buy something. I've heard that a lot. Yeah. And so let's unpack that a little bit. What they're saying is you can buy a piece of equipment, a vehicle, office furniture, office equipment, computers, name your thing that is expensive. That's not like some notebooks that you just buy and write off, like a fixed asset that you would depreciate. Okay. What they're saying is you've made a lot of money this year. You ought to spend some. So let's stop right there and think this through. In the tax world, it is always, not always, but mostly best to not buy things you don't need to save taxes. Let me tell you what I mean by that.
Yeah.
But I get this all the time. If your profit is $100,000 this year and you're like, God, I don't want to pay tax on $100,000. Let me go buy a new forklift and it costs $30,000. Okay, so now you pay tax on $70,000. You could write it all off through what's called bonus depreciation. So now you've reduced your taxable income from $100,000 to $70,000. But what if you don't need the forklift? You've just spent $30,000. You spent it to maybe say, let's just say your tax rate let's just assume this is in like a partnership or an S corp, so it's going to filter down to you. It's a pass through. We've talked about that, and you're in the 22% bracket, and your state, let's just say, tack on another 3 or 4%, call it 25%.
Okay, so I'm lost now.
Okay,
but
all right.
I'm following the principle, but the brackets and the numbers.
Well, what I'm saying is, what does the deduction only saves you the tax rate that you would pay on that income. Okay. So if you have $100,000 of income, you would pay $25,000 in tax. But if you have $70,000 of income, well, you'd pay you would only pay on 70, which is the $30,000 times 25% less. Okay. Does that make sense?
Sure.
So $7,500 less.
Yeah.
So my point is, you spent $30,000 and it saved you $7,500. You didn't come out ahead economically.
Right.
You're in the hole $22,500. Now you have a forklift, but did you need it?
Right.
So that's always my point. The tax is a sweetener to the deal. It's not the reason to make the deal.
Yeah.
Because you still have to pay for it.
Yeah.
Let's change the scenario. You are growing, expanding. You've got big profits this year, but you need equipment. Perfect storm to buy the equipment.
Right.
I need the equipment. And oh, by the way, now the equipment only cost me 75 cents on the dollar. You follow that?
Yeah.
Because I paid 100% for it, but I got my taxes were about 25% of the savings. So really the equipment cost me 75% of what I paid for it. But you can see how you still got to pay for it.
Right.
So my point is, don't rush out to buy equipment, to buy a vehicle if you don't otherwise need one because you have to pay for it.
Right.
So, but suffice to say, that is a planning tool. Buy equipment, but let's get into why you could or couldn't do that and why some things might sneak up on you, what we call the traps for the unwary. So if you're in an S corp and you borrow money to buy that equipment, you could be limited on the amount you can deduct. That's the first thing. So that's just something to think about.
Yeah.
And then if you're in a partnership, it works differently. So I'm not going to get too much into those two details. I just want you to know from listening to this that it's not always I buy a piece of equipment, especially, this is what you need to walk away with. If you borrow money to do it, you need to talk to somebody.
Well, in my mind, if you're having to borrow the money to buy equipment, or you choose to borrow the money to buy equipment, well, then that's you're out of that logic of like, okay, I need to lower my tax bracket anyway,
Well, you can write off things you borrow. You can write off a piece of equipment that you borrowed to purchase. It doesn't have to be a cash purchase. So that's why, I mean, you could think about it. If your wheels are turning now, you're thinking, oh, great, I can go buy a $50,000 piece of equipment, finance it on December 30th, not even make a payment and get a $50,000 write-off? Yes, maybe.
Okay, I didn't realize you could do that.
I know. And so that's why I'm saying that, because if you were thinking
Now
about
I'm
this.
going to buy a forklift.
You might. On credit. You need to borrow.
Yeah.
No, but if you're thinly capitalized, I don't want to get too much in the weeds of this, but if you're an S corp, which your business is and my business is, and you're thinly capitalized, meaning you don't have much equity, that borrow, and we've talked about this before, this S corp basis concept, you might not be able to write it off. You need to be talking to somebody. And so in all these examples, I think the overarching theme is have somebody in your corner with the data. One thing I had on my list, and you told me to take it off, was I had get organized.
Yeah.
And what I meant by that, and I think we're going to kind of talk about this in every one of these, is if your data is really good in real time, cloud accounting, just real quick, you
guys have heard, right?
Yeah, you might have heard me talk about that a little bit. But what I mean by that is you can make decisions later in the year because your data is real time. So the more data you have, better decisions you make. If you're trying to make a decision in December using October data, that means you're guessing on what November and December were.
Yeah.
But what about if your data is so good that on December 20th, it's reconciled and cleaned up and nice and neat through December 15th?
Yeah.
You got 11 and a half months of weight behind you to make a really good decision. Yeah. So I always just kind of give that point. That's really the first thing I think you should do. But you told me I couldn't put that on the list.
Yeah, well, I think it's going to be you're gonna say for all of them. It's point 1A, point 2A.
Right.
You know. So yeah, to sum that up, if you want to buy a forklift, need a forklift first.
Exactly.
That's always good advice. That's tax tips aside, just good business advice is
perfect.
Buy things you need.
Run a good business.
Right.
Run a good business. Don't let the tax tail wag the dog, so to speak. Run a good business, but know the tax implications because they sweeten your business decisions.
Right.
That's what I always tell clients. Like when somebody is blanketly telling you buy things with no caveats, with no nuance, they don't understand your business. Mm-hmm. That's easy advice. If anybody's just saying, oh, just go buy something, they don't understand your cash flow. They don't understand if it even saves you money. Can you write it off? Maybe you don't have any basis. Lots of issues. The point is, if you need it, go slow. Make sure you do need it. Talk to your advisor, because if you're in an S corp and you borrow, lots of factors. Bottom line is work with somebody on that.
Yeah. All right, number 2.
Yeah, charitable donations, pretty popular one. But one thing I think people don't understand how charitable donations kind of fit in the overall scheme of tax deductions. So a charitable donation is what's called an itemized deduction. We've talked about this before. Mm-hmm. Itemized deductions at the individual level, you can deduct them if they're greater than the standard deduction. So the government gives you a deduction. Let's put some numbers to it. Let's just say your adjusted gross income is $100,000 at your personal tax level. And the government gives you, it's roughly $25,000. They just give you a standard deduction. They say, reduce your income down to $75,000 now. Okay? But if your itemized deductions, which is what a charitable donation is, and mortgage interest, property taxes, state income taxes, those are the big ones. If those exceed the standard deduction, then you get that. Well, let's just say you gave $10,000 to charity and your mortgage was 8, your mortgage interest was 8, and your state taxes were 6. That's $24,000.
Okay.
The standard deduction is $25,000. What did you get by donating to charity? Nothing. You were already going to get a $25,000 deduction. So again, like with anything, a charitable donation, great. I'm charitable. I give. It's the tax reason's not the reason I do it, but I also plan it properly to sweeten the deal. So you could be in a situation where you've given a charity at year end and it saves you nothing. Mm-hmm. And you were expecting it to save you a lot of money. So just think about the ways to do that. One cool way, and again, I keep hammering this point, but if you had somebody advising you, they would tell you, hey, Tyler, last year, you didn't even itemize. Like you can give $10,000 to charity and maybe 2 of it's deductible. So just, if you want to give $10,000 to charity, great. But just know that. Yeah. Don't expect this tax boon back to you.
Yeah.
Yeah. One thing we really like, Quentin talks about it all the time, private foundations. So like here in Lafayette, we have the community or donor advised funds. And won't get too much into the weeds of that, but basically you can set up your own Foundation with the community here locally. We have the Community Foundation of Acadiana. You could go set up the Tyler J. Warner Foundation.
That sounds awesome.
Sounds awesome, I know. And it sounds prestigious.
Exactly.
Yeah. Put $30,000 in there. So right then and there, deduction. Again, assuming working through the itemized versus standard kind of conversation. But you could put $30,000 in there, boom, charitable donation deduction, and then later figure out how you want to dole the money out. So it's a great planning tool at year end if you've had a great year, but you're like, I just don't want to, and this is really for high income earners, but I just don't want to go scramble and throw tens and $20,000 around. I want to put it in this fund, think about it, and then dole the money out. So donation deduction right when you put the money in, figure out what you want to do with it later. It's a really cool tool.
Okay. I have a question.
All right. Good.
Because I'm just imagining now the Tyler Warner Foundation.
And you should.
And having a big fundraiser, cocktail party.
Is this do we snap the ribbon with the big scissors?
Yeah, exactly. Okay. We'll get back to you guys on exactly what we're going to be fundraising for. But I mean, what's the minimum amount to do this?
I think you can do anything. I would imagine a community foundation like. Maybe they put a little minimum for administrative purposes.
Yeah.
But I've never heard them say that. So if you're going to do it, yeah, obviously look into that.
Yeah.
But man, what a great tool, because here, I'll get into a little bit about charitable. What's a really neat planning tip? So that kind of concept, I guess, gave you the example of where 1 year you gave charitable, but it gave you no benefit because you didn't exceed the standard deduction. Mm-hmm. What if you doubled your donations every other year? So let's just okay. So I'm gonna give you an example.
How many watermelons do I have left?
Listen. All right. So let's put some numbers to it. Standard deduction is $25,000.
Okay.
Okay. Let's just say you wanted to give $15,000 of charitable. Your mortgage interest was $5,000, and your state taxes were $5,000. So that's $25,000. Okay. So right then and there, the government was already giving you $25,000. Mm-hmm. Your itemized, because you already get a standard deduction, your charitable gave you nothing. Right.
Right.
Well, let's just say every other year you gave 30. Instead of 15 every year, 30 every other year. Let's work the example again. 30,000 charitable, 5,000 mortgage, 5,000 taxes. That's 40 grand. Standard deduction is 25. Now you get the itemized of 40, and now 15 of your charitable becomes deductible versus zero.
By skipping a year.
It's a really neat strategy. That's a great strategy to use with a charitable foundation. Because you can dole the money out. You can put the money in and dole it out on the same time frame that you normally would give.
Yeah.
You know what I mean? So if you were a giver, a tither, so you didn't want like your church or some kind of organization that depends on your donation to wait a year, put it there, and dole it out over 2 years, then do it again.
Unbelievable.
I know. I just thought of that.
Yeah, that's pretty good. In my mind, that's how like Batman gets paid. Yeah.
Bruce Wayne.
Yeah, exactly.
And that's not Batman. That's Bruce Wayne. That's Wayne Industries.
That's right.
Yeah.
All right, number 3.
Yeah, accelerate deductions or expenses, I should say. So if you're a cash basis taxpayer, which most people are, cash basis meaning you only pay tax on the income you collect. You don't pay tax on your accounts receivable, and you don't deduct things you hadn't yet paid for, like your accounts payable. So that would be a cash basis taxpayer. You pay, your income is what you collect minus your expenses. But you can accelerate things. So if you've got bills to pay year end, and maybe they've got a due date sometime in January, or some vendors will let you prepay things, that's a way to move some deductions into the current year. Now, just know they're not available now in the next year, so you kind of kicking the can down the road a little bit, but it is a common strategy.
Yeah, and that only works for cash basis, right?
Yeah. That's right, because accrual, you're already deducting it at the time you incur it.
Right.
Yeah. So won't get into that. I think that's pretty self-explanatory. All right, number 4, write off bad debts. So not so much for a cash basis taxpayer, because a bad debt would have never been included in income, right? It would have been in accounts receivable. You never would have included it as income yet. So this is more for like an accrual basis taxpayer.
Okay.
Make sense?
I don't even know what a bad debt is.
Bad debt is I know
what debt is, obviously, but what's bad?
No, that's a great question. Bad debt is you owe me money, you, the customer, me, the business. I've rendered a service to you on credit. I bill you $30,000 and you don't pay it. It's a bad debt. So if I were an accrual basis taxpayer, I would have included that $30,000 in income in the year I billed you, but I've never gotten it.
Okay.
So then you want to write it off, right? I wish we had that. I wish
Yeah.
we had that Schitt's Creek drop right now, or the Seinfeld one.
Yeah.
But you want to write it off, meaning you want to take it as a deduction. You put it in income in the year you build it. You never got a deduction for it. Bad debt deductions have to be substantiated, meaning you had to make efforts to collect.
Right.
So my point in saying bad debt is really around the documentation requirements and just memorializing what you did to collect on that debt.
Gotcha. And bad debt is an accounting term.
Yeah, bad
It's
debt
not
expense.
not your opinion that it
Correct.
was bad.
That's
It's
right.
like-
No, I'm glad you're asking that because that's like sometimes I think I'm jumping ahead. But yeah, bad debt expense would be something probably what we would call below the line. So below operating income, those things that don't happen all the time. They're more like other income or other deductions. So they're not they're not a normal operation, right?
Gotcha.
But also you can have a bad debt as a cash basis taxpayer. Let's just say, and I've seen this with lots of clients, they'll lend their vendors money. Like, so they're working with a guy, they'll lend him money, and then they don't hear back from him. That's a cash basis like receivable because I gave you
Like
money.
you'll pay your vendor in advance.
Correct. And he doesn't render the service or something like that.
Okay.
You could write that off, or you just lend to people in your community, kind of business people, like different stuff. I've seen that where, again, same kind of concept. You just want to substantiate your efforts to collect.
Yeah.
And when you can say, basically, I tried, I sent letters, I reached out, then you can take a deduction for
Yeah. Okay.
it. Make sense?
Yep.
All right, right up. Obsolete inventory. Okay, so inventory goes on your balance sheet. So it's
Right.
not deducted until you sell it. At the time you sell it, it moves to cost of goods sold on the P&L, on the income statement. But for a lot of people, they'll buy inventory that they never sell.
Right.
So you should always be evaluating, is this gone? Is this, obsolete? And if so, you got to scrap it, like get rid of it and take a deduction for it at the cost you paid for it. So that's a common practice for a lot of people at year end. Let's go through our inventory records and look at this old stuff sitting on the top shelf full of dust and go, we're never going to sell this. Write it off. Meaning, move it from the inventory on the balance sheet to cost of goods sold or some kind of expense account on your profit and loss statement and take a deduction for it.
And you mentioned earlier, like, get rid of it. Like, what are you?
You got to scrap it. You got to, like, if it's obsolete and it's junk, you've got to junk it. Like, you've got to throw it away.
Oh, okay.
Yeah.
Wow.
You got to scrap it.
Yeah.
Yeah.
Wow.
Yeah.
All right.
All right. But this is one I really like, and we're doing this with some clients. This is going to be more for your high income earners. Purchase tax credits. So, like,
This also sounds like
this is Bruce Wayne
inside-
right here.
Yeah,
Yeah,
exactly.
if you want Bruce Wayne, this is it.
Yeah, this is going to be step 2 after I start my foundation.
Well, yeah, I think at the same time, well, in the next meeting, we'll call it tax credit broker.
Nice.
So yeah, buy tax credits, and it's really cool. It's that, let's just say, so let me back up a little bit. There are people that get tax credits that can't use them. So generally, this is when people like get these tax credits at the state level for fixing up historic buildings. Like they get these historic,
Yeah.
like the tax credits we're buying are called historic structure credits. So people will go and renovate this old building, and the government gives them tax credits. They can't use them. Maybe they don't have enough taxable income. They sell them on the open market to these tax credit brokers. Well, the brokers then sell them to people like my clients. Here's the gist. You might get a $50,000 tax credit. So $50,000 meaning that's like a payment of your taxes. If you had a $50,000 income tax bill and you had a $50,000 tax credit, your tax is now zero.
Yeah, I explained this to somebody the other day. It's like imagine getting a gift card from the government.
Perfect. Exactly
Yeah.
right. But what if
And
you
they
could?
were mind blown that I was able to do that. They
Well,
were
what if-
like,
Oh,
"The
it's
heck?"
yeah. But what if you could pay $46,000 for the $50,000 credit?
Yeah,
That's the tax
it's
credit.
like
game.
buying the gift cards
On sale.
or you know how like they'll do that like Christmas time.
Yeah.
They're like buy a $50 gift card for $40.
That's right. That's the exact same thing. So in that example, like that's a familiar pricing, 92 cents on the dollar.
Mm-hmm.
You could buy a $50,000 tax credit for $46,000. Like you heard the term "no free lunch." Like that literally is a free lunch.
Yeah,
Like that $4,000 is money in your pocket. You paid $50,000 of tax with $46,000.
yeah. And so there's like you mentioned tax credit brokers. Is
Yep.
there like you go to a website and do this?
Yeah,
or-
yeah. I mean, there's
And
you
what do they
can.
just give you a certificate that says?
Yeah, they handle the paperwork. Yeah, I mean, I know we have one here in Louisiana called Stonehenge Capital, and they handle all the paperwork. There's a lot of paperwork that goes into it that substantiate the transfer from the state to the broker to you that you attach to your tax return. But we've done it for years.
Gotcha. You mentioned state. So can you do this federal and
I've never
state?
seen a federal. It's
So it's
generally
not for income tax. It's
it's state income tax.
Okay.
Yeah, it's generally state. I've never seen it on the federal level.
Okay. So yeah,
It's really cool, and it's a good. I mean, for people looking for things, it's a really good planning opportunity. I mean, it's money in your pocket.
and you said on average it's 92 cents on the dollar.
92, 93.
Okay.
That's generally the kind of the rate. So you can see that doesn't make sense if you have $10,000 of tax, right? So another one I would say to consider is harvesting tax gains. So this would work if you've got a year where you've sold stocks at a loss, or you have losses carrying forward, what's called a capital loss carry forward. So capital losses, you can only deduct $3,000 every year, $3,000 loss in excess of your gain. So if one year you sold stocks and lost $100,000, those were your losses, and your gains were 30. You have a $70,000 loss.
Okay.
3,000 is deductible. 67 would get carried forward.
Okay.
Okay, a lot of people don't know that.
Yeah.
That's 67,000. Let's just say you're in 2021 right now, and you're like, man, how can I get some benefit from that? Otherwise, I'm just going to get to deduct 3,000 of it. Now 64,000 goes to the next year, assuming I don't have any other gains. But what if you had a stock you bought 7-8 years ago that's run up and has a $70,000 unrealized gain? Why not sell it, pay no tax on it because that loss would offset it,
Okay.
and then buy it back at the higher. So what you've basically done is establish a higher basis in the stock, tax free.
Oh.
Makes
Yeah.
sense?
Yeah.
And let's just say it was a $67,000 gain, just to make the math
Okay.
easy.
That's some real rich getting richer kind of stuff right there.
It is,
feels
but it's
like.
not,
That's like
but-
real inside.
But it's really, if you have to understand it, you have to have somebody looking out for you, working with you. Like that doesn't come from a year end or a once in a year tax return.
Yeah.
Like we just don't know enough information. But that's like if I know your situation and we're meeting, I might say, hey, you remember you got that capital loss carry forward? Any stocks you got that are really done well you want to sell and buy back?
Yeah. And I guess you could do that whole, like, you just take your whole account and do that.
Yeah, you just look at
would
what
just
are
have
the
to find one.
what are the ones that have unrealized gains, big
Yeah.
ones, and long term. That's a good, well, I wouldn't say. Let me back up. Short term would actually be better, but yeah, just look at what's unrealized and say sell that one, sell that one, sell that one, and just buy it right back.
Yeah.
Let's think of the opposite of this too. So one thing I didn't mention is you can't do this on. Let's just say you had a bunch of gains and you were trying to figure out losses to take.
Right.
Well, you can't do that same scenario where you sell a loser and rebuy it. That's called a wash sale.
Okay.
And basically, if you sell something at a loss and rebuy it within a 30-day window, the IRS negates the first transaction and just says that didn't even happen. So if you're thinking, man, I killed it this year in the stock market, but I've got this oil and gas stock or name your investment that's gone bad, I'm going to just sell that one and offset the two and I'll buy it right back because maybe I like it.
Yeah, that's
Can't do
exactly what I was thinking.
Yeah, I'm sure you were. It's good. But you knew the wash sale rule, I'm
because
sure.
I killed it this year.
You killed it in the market. Last one is harvesting crypto losses. So I just told you the wash sale rule, where you sell a stock at a loss. If you buy it back within 30 days, that loss is negated. It just adds to your basis. Okay. Crypto is not that way. A cryptocurrency is not considered a stock. It's a capital asset, meaning you pay capital gains when you buy and sell, but it's not a stock. So what I mean is, if you have let's just say you got in Bitcoin, this is about 3 months ago when it hit 65,000 all-time high. Like you kind of caught the fever and like, crap, I bought Bitcoin at 65, but it's back to 55 now. But it went down to like, I don't know, 28.
Yeah.
When you sold it at 28, and then you could have sold it at 28, and let's just say that would have been a $37,000 loss roughly, depending upon how much you had in it. Use that to offset some other gains in the stock market and rebought it. Because again, there is no rule on wash sales for cryptocurrency. You can sell something at a loss and buy it back the next day. It doesn't invalidate the first transaction.
Yeah. Is that just because it's not actual like U.S. tender? Like, how's that? I mean,
I guess because it's not a stock. Like that's a rule really related to like equities.
Yeah.
Yeah.
Okay.
But crypto kind of trades like that. So I get why people would not think that.
Right.
They would, I'm sure the wash sale rules apply.
Yeah.
It's like a stock. You trade it on an exchange. There's market
Right.
prices. So it feels like it's not a stock, obviously, but it feels that way in the way you buy and sell it.
Right.
But there's some great planning to do. If you bought crypto on the run up a few months ago, but you still want to stay in it, sell it, take your losses, especially if you've got some gains, buy it back. You've harvested the loss, really no harm, no foul, buy it back.
Yeah, that's wild. It seems like it's so crazy that, because like, I mean, I'm not a crypto expert, but like the transactions that I've got with crypto, there's a ton of them.
Yeah.
And that just seems like crazy to have to like keep track of.
Yeah. You have to.
I know.
You look so distraught.
I know. I'm just thinking, I didn't even consider that.
I'm glad you're telling me now.
Yeah,
We may need
publicly.
to consider this. Yeah. But I think if you're listening to this, and one thing I think hopefully that's evident is working with somebody not just in a role of a tax preparer. Like somebody does your tax return on the back end, you're not getting any of this. It's just you're just not. Because their job is not to do this. Their job is to do the tax return, which is why we're moving toward all engagements where we work with people out throughout the year, because we don't want to not do these things. We don't want to just do a one-off tax return. While, we could do that, and I think we do a good job at it, it's not as fulfilling and it's not as good for the client because we're not doing these things.
Yeah. Well, in pretty much every example we laid out here, there were so many variables, so many what ifs. These aren't not just like A plus B equals C or whatever. It's
Right.
It's definitely situational.
Yep.
So the more data, as you're always saying, the more data you have to work with as a CPA, the better equipped you are to get give the best advice.
No question.
And so you got to do all the things we always talk about.
Build that foundation, get it cleaned up, get it consistent, get it collaborative. You nail those steps. You got somebody on an engagement working with you to look at the output of that data. Way better position than not.
And you'll have your own foundation before you know it.
Foundation. What was the other one we said? You said you were going to do. I forget what it was. It was foundation, and then you said you were going to buy your tax credits.
I was going to buy tax
I
credits.
think in the same afternoon where you cut the ribbon at your foundation, you had the tax credit broker meeting.
Right.
Yeah. Bruce Wayne.
Absolutely. All right. Well, I think that's a good place to end it. If any of these things piqued your curiosity or you thought, man, I probably need to look into that more, go to mire.group. Connect with Marcus there, get on his calendar, and you guys can talk more details there. And you can also find other episodes of the podcast that will, give you the nuts and bolts of accounting. So check it out, mire.group. Have a great day.
See you next time.